On this segment, we're going to talk a little bit about a troubling trend in our view. And that really is this significant increase in financial advisors outsourcing investment decisions. Now, I don't know about you, but I would imagine, or at least this is what I think, being in the industry as a financial planner, that one of the most important things that your financial planner, your financial advisor, your wealth manager, your whatever they call themselves, okay, you get the idea. It's the person that kind of helps with your finances, right? Probably one of the biggest things they do is to make sure that your investments are doing the best that they possibly can be, right? I mean, that kind of makes sense. And so the issue is when that's entirely outsourced, the rebalancing, the underlying allocation, how much investment advice really then are you actually getting? And the disturbing trend of this, and there's a lot of layers to this, so stay with us during the course of this segment as we kind of break this all down. The rise in these kind of model portfolios, these prepackaged portfolios, are basically these preset investment templates that are designed by money managers such as large wealth management firms or the like of like UBS, Morgan Stanley, as well as asset managers like BlackRock or Fidelity. And so here are the numbers. The assets in these model portfolios rose to a record $8 trillion as of April of this year. That's up from about $6.4 trillion just a year ago, a 25% increase in just a year. It's estimated that more than 8 in 10 fee-based advisors in the U.S. are now using these models with client assets. The issue is multi-layered, as we said. It also appears that it is very popular and its popularity is on the rise. Over the next 4 years, estimated growth in these model portfolios is expected to reach over $13 trillion. So this is a trend, if you will, or an issue that I think investors need to be aware of, particularly for those that are investing in the range of $100,000 to $1 million. Now, in the financial biz, if you will, that category of investors, that investable assets, $100,000 to $1 million, that is generally known as the mass affluent. That's the title, okay? Because if you got less than $1 million, between $100,000 and $1 million, you're not really considered high net worth because you need more money than that. Certainly not considered ultra high net worth. I don't really know where that break point is, but usually high net worth is above $1 million. Although some people I think say above $5 million. Ultra high net worth is above 10, or maybe it's about 20. You get the idea. But the mass affluent definition, generally considered investable assets between $100,000 and $1 million. And the reality is that certainly if you look at the ads, you see ads on TV, you see ads on the internet, whatever the case may be, that's a segment, if you will, that many advisors and institutions sort of ignore, right? I mean, if you got a minimum of $1 million, you're not really talking to these people in this group, which I guess gives you some insight into why this trend is happening. If you don't have $1 million, then the industry is basically saying, and has been saying this for some time now, we don't really want to, help you. I suppose we'll take your money, right, and stick it into, kind of this prepackaged product thing. I think the messaging, in our view, is kind of makes you scratch your head, because how can you say that you're in this business to help people and improve their lives and all of those kinds of things if you only want them if they've got over $1 million, right? I mean, that just kind of, right? Hard to claim you're a fiduciary if all you want is people with money, I guess, right? But anyway, by the way, that's why at Nelson Financial Planning, we've never had account minimums, nor will we ever have. We firmly believe in helping people at whatever point they are on their financial journey. So, side note, a little commercial. Thanks for bearing with me on that. That shift, though, among that category and investors is really should catch your attention, because there's a few issues with all of that. First and foremost, prepackaged right? Easy solutions are designed for just that, right? I mean, if you have a prepackaged frozen entree, it's a meal. It's prepackaged, but probably doesn't really taste the same thing. Probably doesn't have the same nutritional value as actually like a meal that you cook. So when you think prepackaged, I always go to the kind of those frozen dinners. Super easy to use, super easy to work with. You don't have to pay really a whole lot of attention to it. You just stick it in the microwave and hit the button, wait for the beep. And but the proliferation of these portfolios among the investing public, particularly sort of that mass affluent category, what we refer to as regular investors, by the way. I'm not sure where the mass affluent definition came from, but easy and quick to just jam money into these prepackaged solutions, because these model portfolios typically made up of predetermined selection of funds that sort of automates all the investing, the trading, and the rebalancing, and all of that. So that's kind of the shortcoming. Number one. Number two is that there's a tendency to kind of focus on a limited number of investment managers. And unfortunately here, the reality is that it's all in an effort to more fully control your dollars at every level of how they can be invested. So beyond the advisor relationship or the planning relationship, it's, well, how do we actually get money from the actual investment of those dollars? So oftentimes the financial institution that the advisor or planner or whatever the title is, works for wants nothing more to control every aspect of those dollars through the creation of these model portfolios that heavily feature funds managed by the very same institution of which you are working with. Here's an example. This easy example. In late May, so last month, BlackRock tweaked its model portfolios and added in portions of a couple of its new ETFs into the mix of assets. In a matter of 3 days, the assets in those ETFs surged by 10-fold. Talk about driving dollars to your product. This should strike you as like there's so many problems with this, right? And at the end of the day, any investment that was managing $100 million, we'll say, and now is managing $1 billion, that's a huge difference in terms of economies of scale and how that money runs. And then that obviously creates some investment performance issues as well. Generally, these model portfolios have a tendency to steer a larger portion to the more conservative side, more bond side, more cash side, in order to kind of take the attitude of, hey, we're going to not do any harm kind of thing. And not to say that you shouldn't have some portion of your assets in bonds and cash and conservative stuff, but those funds, those model portfolios have a tendency to steer to that much sooner than you would expect. So what can you do about all of this? Well, first, be aware of the trend. That's what we're here for, to kind of clue you in on what's happening out there. If you're in a model portfolio, or if someone is suggesting that, then start to ask some questions. Things like, how much of the decision-making process is the individual financial advisor or planner actually involved in? How many of the individual funds in the model are being managed by the parent institution? Do the funds in the model portfolio actually have long-term track records of maybe at least 10 years or 20 years? Or are they brand new and the institution is looking to just kind of goose the numbers or the assets under management in those funds? If you can't get those questions answered quickly enough, or there's some vagueness to it, then I would suggest to dig even deeper. Bottom line, it all comes down to what we say regularly on this program: know what you own. That's one of the most important things that you can do as an investor. By the way, Nelson Financial Planning, we don't use that stuff. We're going to take a break. This is Joel Garris here on Dollars and Cents.